Wow, that's 2 weeks in a row, guys, that we have started our broadcast with no sound. Thank you for letting me know. I just ranted and raved for 2 minutes about our guest tonight, and none of that was heard by you guys. So I apologize for that. Can you hear me now? Okay. Hopefully, you can hear me now. All right. I'm going to start all over again. Let's pretend the last 2 minutes didn't exist. Tonight, guys, we are going to be talking to our accountant. Our accountant is George Dube from BDO. And we're going to be talking about something that you may have heard a lot about lately, and that's GPLP structures. Setting up a structure using a general partner, a limited partner. How does that work? What's the purpose of it? Why would you use this as a structure? These are some of the questions that we're going to be answered tonight from an accountant's perspective. And you guys hear us say it all the time that the team members that you have on your team, they need to be real estate investors themselves. They need to work with real estate investors on a regular basis, and that's what George does. We have been working with him as our accountant now for several years, and he's helped us in many ways. So there we go. I can see that you guys can finally hear me, so that's good. It's going to be an exciting night tonight. We're talking everything accounting perspective and how that affects us as real estate investors. Good. Here we go. Let's bring George on. We're going to add George to the stream. Welcome, George. You saw me rambling there all to myself, didn't you?
I did, but to be honest with you, I didn't know there was a problem because I see a backstage little sign. So I thought, oh, maybe I just don't see or hear what's going on. So
Right.
you are
Right.
innocent until you admit a defeat.
Yes. Okay. Well, I'm thankful for all of our viewers who were. I clicked over to the comments and I should have looked at that sooner. It said no sound, no sound, no sound. But now we're good to go. So, George, welcome to our show. I know you've been on our Tactical Tuesdays before, at least once, maybe twice before, and you've shared a lot of golden nuggets when it comes to what we should be doing accounting wise, and you know your perspective when it comes to real estate investment. And we're happy to have you here a third time.
It's a privilege of mine, by all means.
Okay.
And really, maybe I'm setting this up for who knows what, but this tends to be a fantastic group in terms of the questions and whatnot that come about.
Yeah. Hey guys, you just heard what George said. Let's live up to our reputation. If you have questions that you feel you need an answer to, and you think that an accountant can help you answer that question, by all means, throw it in the chat. We have a bit of a topic that we're going to be talking about, but depending on what time we get done that, we can also hit some of the questions in our chat, and maybe as we go, or maybe at the end. But we have George here for the next 45 minutes or so. So let's take advantage of that, and let's tap into his wealth of knowledge. Thank you, George. Okay, so tonight we're talking about GP and LP structures. So George, I'm going to open up the slide presentation that you've prepared. And maybe I'll let you go ahead and just tell me when you want me to move the slides. But you know, the first one here is pretty self-explanatory. What are they? You know, we've heard a lot of talk about them. We know that many of our Ignited members are setting up these types of structures. And why would somebody do that? So maybe I'll let you start to chat a little bit about that and take it from here.
Yeah, maybe we can get through the first few slides here relatively quickly, but it's something like you said, Corey, where even from my side, probably the last, I'm going to call it 18 months or so, we've seen a lot more questions and actual, of course, setups of GPLP structures. And some people are in a spot where they're curious, does this apply to me? And it turns out in most cases initially, no, it doesn't.
Okay.
That said, it doesn't today. It doesn't mean that that's permanent. And in many cases, it's more maybe like another year or two will be there. And for some people, of course, it was 2 years ago, let alone today. But for others, it's more kind of trying to get themselves into a position where it begins to make sense. And that's what I think partly we're going to be talking about tonight is why should we be doing it? Do we need one? And maybe it's not so much a focus on do I need one today, but what are those characteristics or thresholds where all of a sudden I do need that, or how do I really progress to that level, if you will? Because setting that structure up is not something that's quick or fast. It takes some time, and I'll see people balk at the amount of time that it takes. And it's something where, okay, it's not as simple as setting up a corporation where relatively easily you're going to have one in an exceptionally short period of time. The limited partnership is something, while there are boilerplates that exist in terms of agreements and what have you, I would heavily recommend tailoring one that's appropriate for yourself and kind of understanding what some of the major choices are as compared to this is what I've seen on the internet, this is what some other groups do, and not necessarily that those are bad or good. They may not be right for your particular situation.
Yeah. Okay, sounds good. And I know that that's one of the answers to a lot of the questions that you get, George, is well, it depends on your situation, and these types of structures and the setups are very dependent on whatever position that particular person might be in versus somebody else. So it's not like just a standard across the board answer to a lot of the questions that people give you as an accountant, I would imagine.
Right, and even admittedly, I'm in progress of setting up my own as well. And obviously, I have a number that I could use as templates, and it's taken me a fair bit of time to go through and I like this component of example A and example B, et cetera, but I need to create mine, and that takes time. So, if not that I'm a legal expert in the slightest, but if on the accounting and tax side, I like to think I have a fair bit of understanding, and in terms of in general what's happening, but it still requires that thought process in terms of what's right for me and not what's right today, but as well, I need to be thinking about how I want to be working with others 3, 5, 10 years from now, and trying to put that as to the degree remotely possible into the agreement so there's less likelihood of problems down the road.
Okay, awesome. So I know you've touched on this, and you might touch on it again more later in the presentation. I'm not sure, but just a quick question for those that are watching. And I know you mentioned it already about this isn't something that is easy or quick to set up and that sort of thing. Would you say that okay, let's make it easy. Somebody who's starting out and buying their first investment property, this is probably not a structure that they want to start looking at.
Extremely unlikely.
Okay. Okay, perfect. So is there kind of a benchmark where somebody would say, okay, I've been doing this, I've been into real estate investment, I've bought X number of properties, I have some experience, and now I'm looking to move into this structure. Would there be kind of like some sort of level that they would reach before they would start looking at this structure?
There can be, and maybe you can just pop forward a couple slides there, Corey,
Right.
in terms of the first kind of real meat and potatoes one. Yeah, the next one there. But we start listing some of the reasons, but in terms of kind of a threshold, if you will, often it's going to be more, yes, there needs to be some size to the investment. In other words, if we're I don't even know if you can find these anymore, but if you're investing in $100,000 condo, there's zero chance of this being appropriate.
Mhm.
Whereas it's not necessarily that it takes a lot of dollars for it to make sense, particularly if it's being used as a template for future investments.
Mhm.
More, I tend to see the limited partnerships being used where there's going to be a handful of investors coming on board. So it's probably more related to the investors themselves and the scope of what we're trying to do down the road, as compared to strictly the size or the nature of the investment itself. And keeping in mind that a limited partnership, it may start off with whether a smaller number of smaller properties or kind of a medium-sized property, however that's defined from a dollar perspective, with the intention that over a period of time, that limited partnership will acquire more properties.
Mhm.
So again, we don't necessarily need to go out and buy the Taj Mahal in terms of have a monstrous property available for it on day one. It gets into more of where we leading down the road to make it worthwhile.
Yeah.
And not that this is a number that you're going to find in an income tax act or some type of statutory declaration to the best of my knowledge, but where we're starting to look at having kind of more than five investors into a project, I think we start looking more at the limited partnerships. I've seen them where there's fewer than that, and sometimes that's for specific tax reasons that we've accomplished that. There are a couple of ways, for example, of deferring some gains where we've got a development property or we're going to condo it, stratify it, and have the property in a corporation, but want to be able to get some other investment funds in there in a little bit of a different fashion than the corporation. That limited partnership may be a creative way of accomplishing that. We may be jumping into a limited partnership for legal reasons. Again, can't emphasize enough, I'm not a lawyer. You need to talk with your lawyers. But as again, as a general comment, often that limited partnership is put in place for legal reasons. And that's typically some form of creditor protection. And again, the specifics of which the lawyers can certainly much better describe than I. But we also like it from a tax perspective, and sometimes it's don't get me wrong, I'm very very pro corporation, as probably many people here know, but I also like being able to, if you will, kind of focus on what some of the investors may be looking at. And I referenced there as one of the bullet points. Some of those wealthier investors have advisors talking to them about this idea of a flow through concept, which in English means that the tax characteristics of the investment flow through to the investor. And so, as an example, if the partnership is earning interest income or rental income or capital gains, then the investor is going to receive their proportionate amount of that, assuming that's how the partnership agreement is laid out. And they're taxed as if they receive that. And they're going to be taxed then based on how they are organized. So, for example, if they've got a corporation, they're taxed in a manner that a corporation would be. Whereas if they own it personally, they're taxed as an individual would be taxed. So now they have, as investors, an ability to be taxed how they want to be taxed, in contrast to just a corporate setup where they're going to be taxed how that corporation is able to distribute profits.
Mhm.
And again, there's pros and cons to that, but my point to some of my clients is to say if somebody's waving $1 million check in front of you and they want this flow through capability or whatever, you're probably going to be a lot more accommodating than somebody waving a $50,000 check.
Right.
And pick your numbers to whatever number is significant for you.
Okay.
But it gives one less reason for somebody to say no. And as investors trying to bring in funds from others, obviously that's one of our objectives is the fewer no's we have to address, the better off we are.
Yeah. Absolutely. Okay. So, excellent. I know you covered a lot of these bullet points here that we see on the slide, or you might have even covered all of them.
I think we covered yeah, maybe I could just draw that third bullet point there too,
Sure.
Corey, because that tends to be a big item for people as well. And I definitely hear a fair bit about, okay, what happens like in a corporate environment often if the co-venture or shareholder is declared to a financial institution, they're probably part of the guarantees for a mortgage. Whereas in a limited partnership, full disclosure can be made, and they're very, very rarely going to be part of any type of guarantee situation. Obviously, we're making certain assumptions in terms of the quality of the investment and the I'll call the founders for the partnership, but it would be unusual to see the investors guarantee debt, which helps the founders in the sense of fewer hiccups, process, hidden things in the closet, and then from that attraction feature, of course, you don't have to guarantee.
Yeah. Awesome. So, just very simply, so that we don't skip over this, what is the difference between a corporation and a GPLP structure?
So corporation is going to be a corporate entity, and I'm sure a lawyer can give a better description or definition of this, but I will describe the GPLP structure uh, is a general partner, which is almost always a corporation. And it's kind of a target, if you will, for if there's a problem, we go after the GP. The limited partnership is kind of the entity or relationships that are going to have beneficial ownership of properties. And that limited partnership is what people are investing in, such that then the investors are going to get a return distributions from the partnership dependent on how the partnership agreement itself is laid out. So often it's going to be proportionate to other investors, but a portion chunked off for the founders. And usually there's going to be a different waterfalls in the sense of maybe the first chunk of money up to the level of investment goes back to the investors, and now there's a different split that occurs once the investors have been repaid.
Mhm.
And
Okay,
again, I've seen all sorts of different formula for determining that. And that's part of the beauty of a partnership is figuring out what's right for you and the investors.
absolutely. We have a question in the chat regarding the last bullet point here on this page, that it's easier and more tax efficient to convert to a private REIT in the future. Can you explain that?
Yes, and a great question. So it can be that the limited partnerships, and we can use me as an example. I'm beginning to put in place some limited partnerships with the aim of 3 to 5 years from now being able to create a private REIT. And so there can be advantages from a tax perspective of going from an LP to the REIT. And a real estate investment trust is something that people will at times be very attracted to, where they can directly take money from TFSAs and RSPs, for example. There's other points to it as well. But essentially, in its simplest form, that REIT is a trust which owns one or more limited partnerships. And so by putting that limited partnership there in the first place, it's more easily to evolve into that REIT. And so it's a stepping stone for some investors.
Okay, awesome. Hopefully, a Facebook user, I'm not sure who that was, but hopefully that answered your question regarding uh, the tax efficiency of having the ability to do that at some point in the future. Perfect. We'll move on to the next slide, or is there anything else you wanted to cover here,
I
George?
think that's good, Corey.
Okay, awesome. Elements of a GPLP structure. We've kind of talked about this a little bit, but maybe I'll let you go on here.
Yeah, so we certainly talked about the first two items, and they form the core of that structure in terms of in having a GPLP structure, you by definition need a limited partnership, and you by definition need a general partner. So now we're into the potential use of a nominee corporation. And the nominee corporation, there's zero tax benefit to the nominee corporation, but I've seen them more so used. And again, it may not be, for example, as relevant for somebody in Alberta. But if you have, for example, an Ontario project where there are land transfer tax, there can be some, as I understand it, advantages for moving around assets after the fact in using that nominee corporation. So the nominee corporation, maybe I should step back in terms of why it may even be necessary, but I hinted at in the prior slide the idea that a limited partnership is the beneficial owner, not the legal owner of the real estate in question. For some reason, again, more appropriate for a lawyer, a limited partnership, as I understand it, is not allowed to own real estate. And so what we end up having is either the general partner or alternatively, in this example, a nominee corporation will have legal ownership of the real estate, but it's holding it for the benefit of the limited partnership and then indirectly for the limited partner investors that come into place. So the question is more who has legal ownership, whether the general partner or the nominee corporation. So again, it's something from a pure tax perspective makes zero difference in the world. More something that people will end up chatting with their legal team as to what may or may not be of benefit from their particular case.
Okay, awesome. So let me just ask a question here, George,
Mhm.
as we go through this. So GP, general partner, they own it. They're the ones on title. Is that correct?
Yes.
Okay. They're the ones that are getting the financing for the project, or is it the financing is coming from the funds that the limited partnership puts in, or both?
It's really both, yes. So as I understand the financing side, we're most likely having the GP and the founders going to provide guarantees for that. And the financial institution unquestionably is going to, of course, want to have security with the owner itself. But I believe they have both beneficial and legal owners in there in that and again, a lawyer probably better able to answer in terms of precision, but clearly the bank wants to ensure that there is absolutely positively zero way of somebody escaping without having to put that property up for the mortgage. And so I expect that they're going to want both, but a lawyer may correct me to say technically this or that. But the ones I've seen, they would have them both.
Okay, awesome. Thank you. Okay, let's move on.
So we kind of continue with that GPLP structure in that we can have a base structure which absolutely works. Now we can also carry that one step forward. And here I toss in the examples of using a management company as an example. And so you can have the general partner earn management fees. It could be acquisition fees, could be guarantee fees, for example, property management fees relating to the property itself. But if in many ways that GP is kind of appreciating I'm not a lawyer, set up as a magnet for a lawsuit, well, maybe I really want that into a company that has nothing to do with the GP. And it may be done for other tax reasons. So almost always in my particular structuring for myself, I certainly use a separate company for earning the fees as a founder that I'm expecting from the project. It's not a requirement. Just to me, it's more. I don't want to say leading edge because it's been done for a while now, but I think it's a little bit passe to put that through the GP, if you will.
Okay.
Um, the, the the actual investment holding company then for again I'm referring to using the term founders, but and I'm just meaning the people that are organizing this real estate opportunity. But they're going to become for different legal and tax reasons. They're not usually going to use that GP as the way of them holding a percentage. They may have 20-30%, for example, of the property play at the end of the day. And I would almost always prefer to see that their ownership of the limited partnership is done through a separate company. The GP, I would typically see it owns like a fraction of 1% of the limited partnership. So if the GP goes down the tubes, okay, we'll set up a new GP and next week everything is good. Well, I don't want to lose 20% though through my GP. And I understand there's potentially some additional legal protection by having a separate entity do that, where we're able to segregate the operating management activities of the limited partnership versus the investment component to it. And so, again, the more we can protect our money and our assets, clearly the better off we are. So it's not that it's a requirement, it's most likely, certainly somebody working with me is going to have that separate entity.
Yeah. Okay. And just a quick question: when it comes to setting this structure up, do you recommend having a discussion with you or the accountant first, or having a discussion with the lawyer first, or does it matter which order that is done in?
I don't think that it's crucial that it's one versus the other, and both of us hopefully would be certainly involving the other very quickly in the process. And so, if somebody's more comfortable with one or the other, great, start the conversation off. But it's really, really quickly going to involve both.
Okay, awesome. And I've noticed that a lot of the points so far that you're kind of going over is this piece is optional. This piece is optional. This can be optional. So that kind of just reiterates the point that you brought out at the beginning, that this can be set up in so many different ways, and it depends on a person's situation, or maybe the investment property, or whatever the opportunity is. It may be depending on that, if you're planning to be buying something now or buying something in the future. There's so many different ways that this can change depending on somebody's situation. And so I just want to reiterate for everybody that's watching that how important it is to sit down and have this discussion with your accountant and your lawyer, and they will help you figure this out. So if you're watching this broadcast and you're kind of thinking a lot of this is going over your head, or I don't quite understand this, or this is sounding really complicated to me, that is okay. And that's why you have a good accountant. That's why you have a real estate lawyer that has dealt with these things before and can work your situation into some advice and say, hey, yeah, this is, you might want to, considering your situation right now and what you're looking to buy and where you're looking to go, this is a structure that might work for you. And, or they might say, no, this doesn't make any sense and you should set it up a different way. But having that discussion is so important.
Yeah, and if I agree 100% with what you've said, I would add to it as well. It may be that you're setting up a structure such that this is where we're at today, and we meet some more requirements or thresholds, and we're going to make it a little bit more complex, a little bit more complex. But we don't necessarily need to start with the super duper version on day one.
Mhm.
I think it's more important that people understand what the trade-offs are between, I should say, going from very, very simple to the super duper complex. But certainly some of those super duper complex parts can be added in after the fact. They don't need to be day one material. But I don't necessarily want to see a lot of people with the super simple version, in that I think in many cases they are a little frustrated a year or two into it and realize the cost of change after the fact. And that's one of the big things I try to get across to people when we're talking about these structures. So it's a fine business decision to say, in 3 5 years time, whatever it happens to be, I'll have some more money, I'll have some more capacity to invest into the structure itself. And that makes sense. What doesn't make sense to me is we have the money on day one, and 6 months later we change it and incur all these extra legal and accounting fees and finance fees, for example, probably confusion to the investors, when we could have just done it on day one.
Yeah. Yeah.
And so it's not that there's a right and a wrong answer. There's multiple right answers, but unfortunately there's multiple wrong answers as well.
Absolutely. So you touched on something, the cost of doing this. And I know that there's no finite number for that cost, but if somebody is looking at setting up not a simple GPLP, but something that is, but also not something that is super complex, um, what would you say it would be a kind of an average time frame to get that set up, and also an average cost to get all the ducks in a row? Would you say that there's a number and a time frame you could put on that?
Yeah, I'm hesitant to answer in that I found a lot of variability in that, and so I certainly don't mind kind of discussing some of those variables, if you were, or where I see that. The first limited partnership for people, it tends to obviously to take a lot more time to put together, and some of the back and forth in terms. I have one, for example, that I'm dealing with this week. Technically, it started off as limited partnerships, and we're working on a REIT as well at the same time. But it started off September 2021, and we're not done yet.
Right.
And it's not that I'm the fastest of people. I admit that, but obviously this isn't all me here, and it's not all the lawyer. But as people go through the different possibilities, I find that, oh yeah, we want to kind of do this, and they were not starting on a simple situation, but in working with their investors and as opportunities came up, as different properties came up, their business and strategic goals change, and that in turn meant the structure was changing. Most people, they aren't going to be in that type of situation, of course, and it's probably something where um, a 2 or 3 month time frame for a simpler one is probably reasonable. Another one I'm working on, like this week, literally. Again, we probably more so started it in let's say 4 months ago,
Okay.
and very close to completion. But it's had a number of back and forths between lawyers, accountants, our clients, and then clients changing their mind in terms of, and great clients. I'm not commenting negatively. I don't mean it that way, but changing their mind in terms of some of their objectives with the partnership,
Yeah.
and then saying, yeah, okay, we also want to make sure that we can use this as a template for. They have two other acquisitions that will be folded into the partnerships, if you will, down the road.
Okay.
So the time frame is probably, as a minimum, it's probably 2 3 months.
Yeah.
Um, Maximum, I don't know,
Years.
but yeah, it's probably the vast majority should be able to be accomplished in 6 months, unless there's just a lot of changes in terms of what you're trying to accomplish.
Yeah.
And then fee wise, it starts now to depend on, again, is it just the limited partnership? Is it, now do we add well, we have to have the GP, but is there a nominee corporation? Is there investment holding companies, or this, that, and the other thing? And so then from the tax and accounting side, I mean, really, for the most part, whether there's one corporation or 100 corporations, our initial fees are, other than the consulting aspect of what somebody's looking for, one company's all the same. It's kind of a copy and paste exercise for the most part from our side.
Okay.
But that's not true on the legal side. And,
Right.
and, and then with the limited partnership, we find a lot of variability between, is somebody looking for just something the lawyer kind of has as the boilerplate agreement, and they may not want a lot of my commentary to it, and maybe that's a couple grand then type of thing if it's very minimal. The vast majority are going to be a lot closer to $10,000 to kind of start with, having a little bit of back and forth, and a little bit more of a robust analysis of what that structure is, the sorry, I said shareholders partnership agreement. um, but it's not, it's not hard to get to a higher number, as that complexity and the time frame extends out.
Yeah. Okay.
But it's
So
certainly not a, let's set up a corporation and pay the kind of the normal incorporation fee, et cetera. It's, as you can tell, it's a little bit beyond that.
yeah, absolutely. So you have the accounting fees, you got the lawyer fees, you got all these different corporations you might be setting up. So there's it could be 10, it's probably on average, I mean, I don't know, but like if we were to say somewhere between 10 and $20,000 to kind of get things set up.
I think that's probably a reasonable number today to kind of get things going.
Okay.
And then you got ongoing fees with those corporations. Some of those the nominee corporation, for example, the only thing it does is has legal title to a property. It's what we call nil tax return. So you have to file a tax return, but there's a whole whack of zeros on that. So it's obviously not nearly as complex as the limited partnership or a normal corporation itself. And
Yeah.
your accountant is going to be able to provide effectively a lower price, of course, for that nominee corporation where very little is happening
Yeah.
in contrast to the meat and potatoes.
Okay, awesome. So, for those that are listening and maybe thinking that this might be a structure that might work for them, I do have one more question that I wanted to ask before we go back to the slides. But let's just say you're looking at 10, 20, it could be more than that, $1,000 to set up to get this going. You're looking at maybe as little as 3 months, 4 months, to as long as years, depending on the communication going back and forth and how long it takes for people to make decisions to get it set up. So, with that being the case, I guess a question that comes to my mind is, Corey, as an investor, I go out there and I find a really good opportunity. But in order for me to raise the capital and to actually buy that, I need to set up a GPLP structure. And that's what I plan to do in order to take advantage and move forward with that opportunity. Do I set up, so it sounds to me, because of the time frame it takes to set this up, that this is a setup process that you decide on in advance and you set it up in advance. You don't set it up once you've found a real estate opportunity and now you got to get it going, or how does that work?
I've seen both actually,
Okay.
and so I've seen some where it's been a fairly long closing on a property because of that. I think the ones that are a whole lot easier are ones where the founders already own the property and they're looking to transition it from their entity, whatever that may be, to a limited partnership. So they've got a little bit more flexibility. They're not going to lose the deal. Um, the frustration is still there, believe me, but at least it doesn't have that extra element of worrying about the deal falling through.
Okay. Okay.
And that way, I think it's a little bit more practical for the acquisition of property for a new LP as compared to I have my LP and now I'm looking for acquisitions 2 and 3 and 4 for that same LP. Or I want a different LP, but now I can at least use what I've, for lack of a better word, templated, make a couple tweaks to it. But that second and third LP is a lot less expensive, a lot less time consuming to put together in contrast to that. The first one is the killer.
Okay. And then after that, it's easier, usually.
I would suggest I don't want to pretend that anything's perfectly easy, but it, it's significantly easier anyway from what I've seen.
Okay, awesome. Nadine has a question here. Does the general partner provide the personal guarantee, and can a general partner be more than one person?
So often the GP will be owned by more than one person. So there'll be shareholders to that partnership, sorry, general partner, which is a corporation. And yes, they're typically going to be providing the guarantee, but from what I've seen, often there's going to be the founders individually providing those guarantees as well, unless they've got entities or income levels at a corporate side, for example, that are substantial.
Okay, awesome. Let's go back to the slides. Where do you want to go from here?
Well, maybe I'll just touch on a couple of these, and we won't really get into. But and you narrowed in on there before, Corey, to say there's elements of this structure that are optional.
Yeah.
We don't necessarily need them. There's a lot of pros to many of these things, and I frequently see these. But I may be popping in place that family trust, and often, particularly that family trust can be an enormous benefit, particularly if I'm measuring medium and long term as in contrast to short term benefits. Beneficiary companies, I won't get into the specific details to those, but they're awesome. The nice thing is you typically, particularly the way I structure it, at least in my case, um, and for my clients, I don't necessarily need those on day one. I can set those up after the fact. The other investment holding companies, again, in a similar way, often I'm setting those up afterwards. I don't necessarily need them on day one for my structure. The TOSI friendly family trust, and maybe there we'll just say, hey, there's an opportunity depending on the situation, and it's not going to be for everybody, but there's a possibility of saving $30,000 a year per child, for example. And it doesn't need to be children, it can also be adults as well. And so, no, it's not for everybody, but if it's for you and you're saving 30 grand a year, if you're not having that conversation, I mean, you should be taking Corey out for a lot more golf and scotches and stuff because the money is not important to you, apparently. Um, Prescribed rate loans, again, some more techniques to use to save some funds. And again, these are just all examples of things that we can kind of piggyback with the structure, making it more effective from, in this case, from a tax perspective.
Okay. Awesome. Yes. Saving 30 grand per person. That sounds good to me. All right. Perfect. Well, we have a couple more slides to go through here. So let's describe this one,
Yeah,
George.
this is just more for people that are a little bit more visually able to grasp. And again, the simple structure, the limited partnership is the oval, general partner off to the side is a corporation, and there's going to be multiple investors. It can be as simple as that.
Okay.
And flipping to the next one, now it gets more complex. We've got a couple family trusts that are in there that are referenced from the prior slides. And we touched on the beneficiary company, management companies, investment companies, all sorts of different things that can be put into place. It's not that we need them all, particularly on day one, but this is ultimately what your structure might look like down the road. And obviously, that assumed there was one limited partnership as compared to limited partnership number 2, 3, 4, and 18.
Right. Absolutely. Okay.
Yeah, you can flip over. And oh yeah, I think we touched on, we certainly touched through this flow through concept. I guess I didn't address the tax part to it to say that essentially, well, no, I did touch it. If we're a personal, if we're a corporate owner, we're going to be taxed accordingly. Um, that second bullet point there in terms of preventing double tax, I mean, I doubt if you have very many viewers here that wanted to pay tax the first time, so certainly weren't lining up for the second time.
Hmm.
And the nature of the income for the different entities, again, is something that limited partnership is, it shines in that it allows that flow through so that the investor can be taxed how they want, not so much when they want, but how they want and what rates they want based on the normal tax rules for various entities and what have you. So again, very, very flexible that way.
So for the limited partners, they are taxed based on how they brought the money. So, for example, if they did it personally, then they're taxed personally. If they invest with a corporation, then they're taxed based on their corporate tax. Am I understanding that correct?
That's largely it, Corey. The only thing I would add to that is if, for example, again, if it was a capital gain, they would be taxed as if they received that capital gain directly as an individual or a corporation.
Okay.
And if they had foreign income, it's treated as if they received the foreign income. It's, again, this concept of a flow through where um, the corporation is allowed to pass that through. Sorry, the limited partnership is allowed to pass that through, in contrast to a corporation, which is going to pay the profits out as dividends or interest or a capital dividend account for payment, for example. But the corporation's more limited. Not that that's bad. I mean, I love corporations. Don't get me wrong, but the limited partnership has that more flexibility to it.
Yeah. Awesome. Perfect. You're making this as easy as it possibly can be made. So I appreciate that, George. That's one of the difficult things to do, is to make something complicated easy. And hey, I have never, me and Tiffany have never or we have never set up a GPLP structure. And so, for us not doing it personally, it's great to learn about how others are doing this, and the recommendations that you have, because we hear about it all the time and it's becoming more and more popular. And so it's good to have an understanding of it.
And if it's the difference between acquiring that, I'm throwing a number out there, 3, 5, $20 million property or group of properties, and not acquiring them, the setup costs are not cheap, obviously. But
Mhm.
really quickly, if you had a $5 million property, those setup costs are an immaterial number to that.
Yeah.
And so you have to look at the value add component as compared to strictly the cost.
Yeah.
Here with this slide, this is I think our last kind of practical slide. And again, this is one of those we can add it on type of things, and it's this is not unique to limited partnerships. So we're seeing a lot with just with somebody with family trusts and corporations, for example, or it can be just, again, just even with a simple corporation. But the planning is basically, I like to describe it as using other people's money to pay for my taxes. So I don't want to pay taxes any more than the next person does. I don't mind. Sorry, it's not that I don't mind. I accept that I have to pay my fair share.
Hmm.
It's not that I like it. It's just, okay, that is what it is. It beats alternatives. But if I can find somebody else that would happily pay my taxes and it doesn't come out of my pocket directly, I'm thrilled with this concept. And
Hmm.
again, so it's not for everybody, but for somebody that doesn't mind leverage, they like the idea of being able to invest longer term as compared to an immediate result to something. They're doing something for. Uh, I've seen it being used kind of the clear example is succession planning with kids, but it could be nieces, nephews. It could be something where, wait a minute, I just want to benefit a particular charity, for example. I don't even need kids or nieces and nephews, or maybe it's different family members, and it may not be. I can get some immediate benefit out of it when done properly. There's gotchas to this, no question, and somebody needs to do real analysis in their own particular situation to make sure it's appropriate for them. But it can make a huge difference where I'm trying to buy out a partner, I'm trying to acquire a cottage, I'm trying to do different things, and we can be fairly creative with this planning. But the whole concept is, let's have that conversation because somebody else wants to pay for your taxes. And that should be jaw dropping to most people.
Absolutely. Um, IFA, what does that stand for, George?
I've had, there's a couple different versions. The terminology I'll use, immediate financing arrangement.
Okay. Okay.
And there's a couple of different versions of what that stands for, but that's the one I've stuck with anyway. And it's something where people can Google, for example, and they're going to find there are the big five banks, the big insurance companies all have some sections on their websites, or I shouldn't say all, but the last I looked, several of them did, and probably all of them, in terms of some of the pros and cons of this. Part of the big parts to it are, a lot of people might talk about it. There's different versions of it. There are different similar things to it, but this is still unique. And I've had the opportunity of working with quite a number of different people, of course, both clients and different advisors with respect to this. George is not an insurance expert, doesn't pretend to be, et cetera, et cetera. And quite frankly, for the most part, I found I just want to work with a couple of specific individual groups, slash groups, I should say, that I've done this with before because I've seen what happens if it's not done correctly.
Yeah.
And like working with a variety of different people in real estate. I mean, I'm sure your group knows the benefits of working with those that know versus those that might know next year.
Yeah. Absolutely. There's that cannot be understated. That's for sure. A quick question from Nand and Vanessa. In a GPLP, what document describes the responsibilities of the GP and that of the LP? Is there a name to that?
It's actually the limited partnership agreement itself.
Okay,
And that's going to describe the nuances between in the relationship. Yes.
perfect.
And that's again typically a 10-20 page agreement. Well, actually it can be a fair bit more. One I was looking at yesterday, I believe, was 48 pages, for example.
Okay. And would you say in general those are easy to read documents, or do you kind of need your lawyer to explain it to you?
For sure, you need legal and tax advice, but
Yeah,
they're not. It's not a foreign language. There's going to be elements that, with all due respect, you'll miss the significance of.
yeah.
There are elements, I'm sure, from a legal perspective, I miss the significance of. I like to think I've got a little bit more experience with it and hearing a number of lawyers go through it with multiple client scenarios, but I still won't pretend to be an expert in the slightest from the legal side. I still learn things from the different lawyers that are going through those agreements. So I would expect somebody that hasn't gone through as many as myself would find that even more so.
Yeah, absolutely. Okay, good. So let's we got a couple minutes left here, George. Let's wrap this up. In conclusion.
Yeah, so the conclusion is, again, we're not trying to pretend that the GPLP is for everybody, but it might be for you and it might not be for you today. Maybe it's for you a little bit down the road. And there are other elements to that family trust, sorry, the GPLP structure, such as the family trust or using other people's money to pay for taxes, the income splitting on the TOSI side, that we can be taken advantage of whether or not you're using a GPLP structure. I think more of this is to say, let's kind of gear things up from going, there's nothing wrong with investing personally. There's nothing wrong with investing at a corporate level. Maybe we can kind of start to hit some other stages as we progress further in those investments and begin working with more and more other investors.
Hmm. Okay, awesome. And you've mentioned it, but perhaps it's time for a tax and legal checkup. What happens in a tax checkup, George?
To me, it's an opportunity to sit down with an advisor, and whether you are regularly working with somebody or it's kind of the first time you've done it, I still like I still like working with our clients. I may have known them for 20 years. I still think they need a tax checkup periodically
Hmm.
because their situation is going to change. Their goals are changing. Their family situation is changing. Investor situations are changing. Tax situations, legal, financing, etc. situations are changing. So, are we getting ourselves into a position where we're okay now and can nicely transition to where we want to be? Or do we need to start making some tweaks to that? And often that may just be an hour discussion to say, let's kind of see what's there. And yes, that hour may produce, okay, now we need to do this, this, and this. Okay, that is what it is. But now we've got that idea of what we need to accomplish. We can start putting in place some specific objectives, costs, who should be involved with it. It's not obviously just from a tax perspective, but it's going to involve legal and other professionals, other investment advice, financing, etc. Let's start to put a plan in place to knock these things off.
Absolutely. Absolutely. So much better to plan these things in advance than trying to fix them after the fact.
Much
And
cheaper.
it's much cheaper, exactly. And we might look at this and say, well, it's going to cost me hundreds of dollars to have a checkup, but that might save thousands. And it might cost us thousands to have a checkup, depending on what we end up doing after that. But it might save us tens of thousands or hundreds of thousands in the future. So, uh, I can't stress it enough for everybody that's listening. If you haven't done it, do it. If you're looking for somebody to do this with, George and his team is the place to go. They're the people that we've used to sell businesses, to do our taxes on our corporations, and do many other things over the years. And we can tell, George, by our conversation that we've had over the last hour or so, that you have some experience when it comes to this. You can explain it easily, and we really, really appreciate that.
Thank you. It's still exciting for me, which is that's important. I think you want advisors that they're excited about what they do. They want to help, and not that I'm the only one. I'm not trying to pretend that in the slightest, but uh, you definitely want that excitement involved.
Absolutely. Jules, just put your name and website and email up on the slide. I actually had a nice little banner prepared for that I will get running there
There
right
we
now
go.
as well. And awesome. Well, thank you very much, George, for joining us today and sharing your ideas on the GPLP structure. We really appreciate that. And just so everyone knows, all of our Ignited members, George is going to come over with us into Zoom and be there to answer some questions. I know a couple were pre-submitted already, so we're going to talk a little bit more in depth. And thanks again, George. We really appreciate you coming today.
Thank you, Corey, and thank you, everybody. And I apologize. I see some chat comments, but I kind of get narrowed in on the chatting, I guess, and so it's not that I intentionally ignored, but
Yeah, no
thank you.
worries.
And
No
I have
worries.
seen some of the thanks, and
Yeah,
greatly
well,
appreciated.
everyone's saying thanks, George. Thanks, George. And so it definitely is appreciated. So thank you again, and we'll see you over in Zoom there, George, in a couple
Excellent.
minutes. Okay, take care.